in this city, or perhaps the state of wine and divine. I assure you that both were badly needed for addressing these amendments, and the confusion which is gathered out of these amendments. So I started hunting for both, first wine and thereafter the divine. As far as wine was concerned, I understood very fast that it was a controlled commodity and was available in very limited rooms to very limited number of persons. So, but I have been assured that if I do well, perhaps something would be shared with me. Then the only option was to hunt for divine. And so I thought that maybe something would help. So I went to Auroville. Unfortunately, I was not allowed to meditate there. And by the time we could see even the door, see everything was closed. So that divinity was blocked. From there I rushed to Arvind Ashram, thinking that some divine blessing would be available there. That too was not to be, for the reason that we could reach there only after 6 o'clock and the entrance was blocked. Perhaps everything was not uncharitable. So there was an elephant, a she-elephant, Lakshmi. So I requested her that why don't you bless me, and she blessed me with Saraswati. So let's see that whether this divine help also would help us. The best thing I could find was the divinity has come from the participants and from all my group leaders. I'm extremely thankful to them, and the mentors would agree to this, that who were also present, that group leaders have taken the groups, to all the provisions, the facts have been explained in detail, the law also has been introduced to them, and that would, I believe, would save a lot of time, whereas I would not be required to present the facts before you, neither explain the provisions of the law, though these being new provisions, perhaps there was a need to explain them. But because of the size of the number of the issues, which we have to deal with, this aspect also may be spared, and we will straight away jump to the issues under consideration, and wherever need be, it would be supplemented with some provisions and other things. Case studies, as you would normally see, has two different facets. Usually, one would refer to whatever one wants to discuss his thoughts in a narrative style, in a commentary format, and not in a case study form. So one was wondering that what could be the reason for presenting things in a case study form. I could think of two things. One was that, that you wanted the facts to be introduced to the participants, and thereafter the issues were concealed in the facts, so that something better came out. It was kind of a mind twist. The other one is that case studies are expression of ignorance. As far as I am concerned, I would settle with the later one. You would see that this is nothing but an expression of ignorance as far as I am concerned. It is littered all over the paper, and if some of the issues you have felt that could have been not dealt with or may not have been placed in the paper, I am the only one who is to be blamed. I am seeking answers, and as to be very sincere about this is that these are the issues for which not necessarily complete answer would be available in respect of most of the issues. In such time, the board would clarify certain things, or the judiciary settles its position, because these are the issues in respect of which the judiciary even has no occasion to examine them, because these are the new places. I was hoping that the board, following the Finance Act, introduces a circular which would explain in detail that what is the board's idea about certain cut-off dates, about the applicability of the provisions and such other things. Unfortunately, that has not happened, and therefore we are left with the situation where we will have to find our own answers, which I would believe is a better thing, instead of being guided by the board in most of the things. With this limited introduction, let me present my views. I also usually prefer to present my views, by remaining standing, for different reason other than Mr. Inamda's reason. My reason is I am a married man of so many years, And whenever I need to present my views, I am required to stand up. So with this, we would move to case study 1 and the first question. Yeah, that's true, but otherwise it's a hard journey. Yeah. Sorry for this clumsiness. Yeah. The first question is about land in outskirts of. This is about agricultural land. The issue is being tested in the context of section 2(1)(a). The first question is that how to measure the distance from municipal limits, 10 kilometers or 7 kilometers. Now what has happened is, by virtue of an amendment which has been introduced because of certain decisions which have been delivered by the High Courts and one of the tribunal also, wherein a view had been taken that when it comes to measurement of a distance of than 8 kilometers, you need to see that that how the land is approachable. So that is the distance which is measured by road. That is the one which was required to be computed. The amendment now provides that that is not acceptable. Instead of that, now the distance is to be measured aerially. So this is the short point which just was required to be introduced. But the two issues which emerge out of the amendment are important to be appreciated. The Punjab and Haryana High Court, while deciding that the distance was to be measured in a manner whereby one reaches by land to the place, that is motorable road in short, this thing. The real reason why Punjab High Court was motivated to decide in this manner was that it stated that if we had not come to this conclusion, then we would not have supported the urbanization requirement of the urbanization and the population, because the measurement of a distance had an effect on the notification considering the urbanization of the land. Now, this very particular aspect which had motivated the court to come to this conclusion remains still open, though now there is a specific provision which would hold that yes, it is to be measured aerially. The other difficulty which would also arise would be that when it comes to motorable road, measuring the distance is easily done. But when it comes to deciding what is the aerial distance between the 2 points, there is a difficulty because no data would be usually available. See, when it comes to lake or a creek or a river, it perhaps is possible because you know the breadth of the river or the creek. But when it comes to a land which is, which is disjointed by a mountain on the way, then unless you know the diameter or the circumference of the mountain, it's not possible that that how would you aerially determine it unless data is made available. What is important is the non-availability of a data, and the other one is what motivated the court to hold that as the crow flies is not perhaps the correct measure of distance, continues to be that, namely urbanization, and that population part continues to be relevant. Other than that, it is now clear. The next question is how to ascertain the population of a municipality. In this case, as per the latest survey, latest census, the population is admittedly beyond 10 lakhs, that is 12 lakhs. But as per the preceding previous survey, it is 8.62 lakhs. Now, in such circumstances, should you take the preceding survey or the latest survey basis? The answer is available in the provision itself, which says that the last preceding survey would be the one which will determine what is the population of a particular municipality. So when you happen to be, on a land which is in the periphery of a municipality, then the population of municipality will be determined with the last preceding survey. Again, here nothing much turns on. The only thing which requires to be noted is that all of us in section 3 and otherwise are aware of the term called immediately preceding year. We are not, what is the last preceding census? A preceding census is also a preceding census. What is perhaps desired is the latest preceding census or some other thing. But the sum and substance is the population in this case would be 8.62 lakhs, which is less than 10 lakhs. And because it is less than 10 lakhs, the distance limit would not be 8 kilometers but would be 6 kilometers. Can one plead that income is exempt as government has not issued any notification? The answer to that is that earlier we had the High Court decision which has said that if government has failed to issue a notification, then in that case the land continues to be an agricultural land even though it was within the peripheral limits of a municipality. To do away with the ratio of this decision, now it has been provided that no notification would now be necessary. If it is issued, welcome, but if it is not issued, you still need to measure the distance and measure the population. If you, on both counts, if you fall flat, then in that case it will be a non-agricultural. Is of a non-agricultural income. Is income from building and farmhouse taxable? Now, if you would see that this amendment which has been introduced, apparently, one gathered that on the first blush, is that that this is applicable to agricultural land also. However, on a deeper reading, one gathers that it has a very limited application. This population census business or 2 kilometers, 4 kilometers, and 2 kilometers, 6 kilometers, and 8 kilometers is only for the limited purpose of determining that whether the building which is constructed or which is available on the agricultural land, the income thereof is an agricultural income or it is not. It has a limited application as far as 2.1a is concerned. 2.14 we shall deal with it separately. So if one understands that, then it is in this case, what is important is that if a building is used for non-business purpose, then in that case the income thereof would be exposed to taxation provided the building is on a land which is within the restricted territory, within the periphery of a municipality. Is income from sale of cultivated wheat taxable? This is precisely the point which we have to take home is that as far as the income, the real agricultural income is concerned, which is in the form of clause A, B and C, and which are they? From cultivation, from conduct of agricultural activity, from a processing which is essentially necessary for the purposes of making the agricultural produce fit to be taken to the market and selling the agricultural product. These three continue to be independent of the amendment, independent of the location of the land. If you have an income from an agricultural activity of one of these three kinds, that would continue to be exempt, irrespective of the fact that whether the agricultural activity is carried out in the city of Chandigarh or in the outskirts of Hisar, this would continue to be exempt from this. These 2 plots at Hisar is actually 2 plots at Chandigarh. I am sorry for that, it was a mistake. Yes. Is rental or notional income from farmhouse taxable? This again is a question. Now this is a farmhouse and it is not something which is put to use for business purpose. Unless it is being occupied by persons who are the cultivators, who are the workers. So the question which is to be considered here is that income from farmhouse on a land which is within the municipality, if that farmhouse is not used for purposes of business but for use for dwelling purpose, then in that case the provisions of section 22 would apply. The notional income or the rental income in relation to these particular, because of amendment, not in respect of this farmhouse but otherwise because of amendment, the income from such building would now be exposed to taxation. This is something which we need to. Unless it is one house and self-occupied property or such things. I'm sorry. Okay. The next is income from sale of cultivated wheat on a city plot taxable? The answer is the same one. That yes, it would continue to be not taxable. Is capital gains on sale of building taxable? Now this one of the plots is sold along with the farmhouse on it, and for a consideration which is also possible to be divided into one attributable to building and the other one is. The issue which we are trying to test here is that is this income taxable, and for this we need to now see the amendment in section 214. Almost similar amendment has been carried out in 214 also. So whereas a land which is within city limits is not affected by amendment, which was always exposed to taxation if it was an income on account of a capital gains, on account of a transfer of an agricultural land. So this is a Chandigarh land, an agricultural land which is transferred, and therefore income thereof would be taxable. The following issue which one needs to examine is reinvestment of capital gains in purchase of another land within city limits eligible for exemption under 54B? On an apparent reading, one would gather that 54B is applicable, is possible for an assessee to claim benefit, but the benefit is restricted to capital gains on sale of land only, agricultural land. So, subject to compliance of other conditions, the primary condition is that you need to purchase another land to be put for agricultural purpose. Siddhant Karani, who has been a group leader, has also raised an issue stating that should it necessarily be an agricultural land? Apparently 54B what it requires is that the land which you purchase should be put for agricultural use, should be put to agricultural purpose, and if that is complied with, if that is possible, then in such a case, independent of whether it is an agricultural land or not, one would continue to gather the exemption. The point which has to be appreciated is that 54B is not available in respect of the sale of the farmhouse. That is independent, and that if you are otherwise eligible for section 54 benefit, subject to compliance of other conditions, you are welcome to take that. Are the plots at both the locations liable to wealth tax? As far as Chandigarh plots are concerned, also the farmhouse is concerned, they will not be held as on the valuation date, and on that account it should not be difficult to be not exposed to wealth tax. As far as the other plot is concerned, as we have seen that it is outside the limit of 6 kilometers of municipal periphery, and therefore would not be an urban land, and therefore would not be liable to tax. The other plot which is there within the city limit of Chandigarh should surely be treated as an urban land under section 2EA, red with explanation, and therefore in such circumstances should be exposed to taxation of wealth, subject to a caveat that if the land has been notified to be an agricultural land available for agricultural purpose, this is a separate notification independent of 218. This notification is under 2EA of the Wealth Tax Act. So if it is so notified by the central government available for agricultural use, then in that case it will not be exposed. As far as farmhouse is concerned, you are welcome to claim an exemption in respect of any other house. If you do not have that exemption, by meaning that you are exhausted in respect of some other house, this would be exposed to taxation as well. Other group has stated that this might be treated as having been used for business purpose, then I have no objection to that, then in that case it would be so. But yeah, considering that this is for dwelling purpose, there is a difficulty. We come to case study 2. Case study 2 is in respect of 43CA, and now we will be sleeping deeper waters. Now, there is an amendment, there is a new provision in the form of 43CA. There is an amendment in 56(2)(b)(7), and there is a new provision 194IA. On a first blush, we would believe that all three are moving in the same rhythm, perhaps having the same language, and would therefore understanding or learning few facts about a particular provision could also enlighten us or enrich us in understanding about the other provisions. Whether it is really so or not, as we will discuss, we will come to know. This case study too is about 43 CA. 43 CA in nutshell, which all of you are now very, very familiar with, is that is applicable in a case where a consideration that has been received or is accruing. A consideration that has been received or is accruing as a result of transfer. As a result of transfer of a land or building. And the value receivable in this or consideration receivable is falling short of, is less than the stamp duty value assessed, adopted or assessable by the state government authorities. Then in such case, there is a difficulty, and this stamp duty value would be considered as a full value of consideration. The first thing which we need to notice here is the language is verbatim picked up from section 50C1. Verbatim picked up, barring the point that it is 50C talks about capital asset and 43CA talks about other than a capital asset. So language is verbatim picked up. What is true or what was good for 50C in respect of a charge which arises on transfer of a capital asset is also considered to be valid for the purposes of taxing a business income. So therefore, transfer has been given an yeoman importance. So when we appreciate this particular part, few things which we have noticed is that it raises certain fundamental questions. That what is land and building? What is a transfer? What is the year of transfer? And what would happen to all those millions of transactions which have taken place up before 30 or up to 31st March 2013, in respect of which some event has remained to be completed, which would take place in the current year, AY 14-15, or subsequently. These four things, if we appreciate, most of the issues which we are going to address later on, time permitting, we will address each of these issues, is there would be a greater clarity, and therefore, let me first take up few things like land and building transfer and all that, which is unrelated to specific question but would generally be applicable, and therefore let's understand that what is land and building. Land and building being the simplest, I have taken it first, and thereafter we will take up transfer of such other things. Now, as far as land and building is concerned, this is not defined. Therefore, the issue arises that is it the same as land and building simpliciter as also any right or an interest in a land and building, and therefore any immovable property would therefore be covered by this land and building. We have definition of immovable property for the purposes of chapter 20C. Also available under the Bombay Stamp Act, also available under the Transfer of Property Act. But when it comes to Income Tax Act, land and building have remained to be defined. So alternative therefore was to use that whether such terms are used elsewhere in the Income Tax Act, and one readily finds that yes, they are used in the recently introduced new provision of section 50C. The next question was therefore that has this been examined by any of the courts or the tribunals? The answer to that is yes. So why not therefore apply not the ratio, but why not apply our mind to those decisions and whether they would be helpful in the context of 50C. Now one would see that the Bombay Tribunal and later on Kolkata Tribunal, in the case of the Kishori Gaitonde and Tejinder Singh, have held that tenancy rights are an interest in land, but they are not a land, and therefore provisions of section 50C are not applicable. The next is in respect of a lease. Bombay Tribunal in Atul Purani's case held that a lease is an interest in a land and provisions of section 50C are not applicable. Then the next is development rights. When you grant development rights in respect of land, when you permit the developer to develop land without actually effecting transfer under the Transfer Property Act, is it a transfer of a land or is it a transfer of an interest in a land? So this aspect has been examined by Mumbai Tribunal in two cases, Arif Akhtar Hussein's case and later on in the in Chiranjeev Rao Khanna's case. In both the cases, for some strange reasons, in spite of there being cases wherein it has been held that an interest in land is not a land itself, not a land certificate. In both these cases, the provisions of section 50C were found to be applicable, not with great fanfare or discussion. They simply perhaps were swayed by the fact that there was a transfer. There could be a transfer, a development agreement after Chhatrabhuj Dwarkadas is widely accepted as a case of a transfer, unless the possession is not parted. So in such case, therefore, here are the two cases wherein it has been noted that there has been a transfer of land and 50C is applicable to that. So this is one area which we'll have to keep in mind. So there is, a contradiction or division of view already available. As far as the introduction of a capital asset into partnership is concerned, again, a Lucknow tribunal in the case of Carlton Hotels has taken a view that provisions of section 50C are applicable. So in such cases, when there is a conflict, the difficulty that arises in my mind is that that whether 43CA, what is the land? Better view to me would be that yes, one will have to go by the position that what is desired by section 43CA, what is exposed by section 43CA is the transfer of a land or a building and not an interest or a right in a land or a building. However, when we come to applying 43CA, there could be serious issues when we take this view and therefore we would try to understand it further later. The next issue that requires to be appreciated is generally, once again, is what is the year of application of section 43CA? Should it be in the year of transfer and that too of a transfer of land and subject to our discussion on transfer, which we will hold a little later on, let's appreciate that is there a clue in section 43CA itself which provides us that what is the year of application which is desired. In the first in 43CA1 would not throw much light. Second simply takes you or transports you to section 50C and therefore that also would not. 40CA3, that is subsection 3 and subsection 4, perhaps may throw some answer. 43CA provides that in case where the agreement, in case where the consideration fixed by an agreement is different than the stamp duty value prevailing in the year of registration of transfer. Different than the value prevailing in the year of registration of transfer, then in such case, do not go back to the year of agreement, but you are permitted to adopt the value, stamp duty value as on the date of agreement. This perhaps is indicating that what is desired is the year of application would be in the year of registration of transfer. Because it is in this year you are taken back to the year of agreement or the date of agreement. This is a relaxation which is provided. Before we readily conclude on these aspects, 2 or 3 things which we need to appreciate here. One is that subsection 3 strangely talks about the registration of transfer. Now those of you who practice the other laws would appreciate that you never register a transfer. You register an instrument. You pay stamp duty on an instrument which on payment is registered later on. Transfer is an act, is not a document that is to be registration. So this is not properly worded in my view. Is what was required was that they should have either said that registration of deed of transfer, that would be perhaps the sale deed, or they would have said registration of agreement for transfer. Now there is a merit in what we are discussing and would be cleared when you refer to 56(2)(7)(b), proviso 1 and 2. Proviso there does not use the word transfer. Value or consideration fixed on agreement, subsequent registration thereof, or subsequent registration. There the word transfer is not there. The correct position in my view therefore would be that as far as subsection 3 is concerned, what is desired is registration of either the agreement for transfer, and perhaps it is in consonance of the first thing. What is desired is that if there is an agreement which is executed, which has remained to be registered, and for some reason it is registered at a later date, you are allowed to relate back, and go back to the date of agreement and adopt the stamp duty value as on that date. But the real issue we are testing here is the year of application. That year of application, as one would notice, that if one agrees with my view about reading of subsection 3 would be the year of registration of agreement for transfer. It is the registration which perhaps is the heart, is the essential, is the sine qua non of the application of section 43CA. Unless a registration happens, 43CA would not have a teeth to buy unless you voluntarily decide to offer income on your own without registration. So this is one, if we agree to this, perhaps we later on, while addressing the questions, things would be different. There could be a different view, but we have to come to some conclusion. And when we reconcile this with method of accounting, perhaps there would be some logics that would be supplied in the madness which has been generated by these amendments. This is one. As far as 43CA is concerned, year of application. Let me simultaneously also take it up, the provision of 56(2)(7)(b) and the year of application, because we are talking about year of application. 56(2)(b), usually you would see that it creates a charge of taxation on receipt of an immobile property or a receipt of a property. It is unrelated to transfer. It is unrelated to transfer. Now, if one takes a view that receipt happens only on transfer, it is a different thing. But apparently, it creates a charge on receipt of a property. So therefore, if the property is not in existence, 56(2) may fail also. So therefore, what is important is receipt, and the primary proof of a receipt is possession and enjoyment of the property. The confusion has been created by insertion of the beneficial provisos 1 and 2, which has, in its desire to give some benefit, has provided for an agreement, has provided for registration of agreement, and has also provided for the stamp duty valuation and such other things. To me, all these provisos would not extend the scope of the main provision, unless it is a beneficial extension. So as far as 56(2)(7)(b) is concerned, what would be of paramount importance would be the year of receipt of the immobile property. As far as 194IA is concerned, year of application. On a deeper reading of the provisions, though here also there is sufficient noise for transfer, there is sufficient place for the consideration, one would primarily understand that 194IA is a provision which activates itself on payment or credit, whichever is earlier. Though this payment, I am aware that is of a consideration, and consideration should be moving on account of a transfer. If one would take a holistic view, a composite view as far as 194 IA is concerned, what is important is that you need to make a payment in respect of a consideration for a transfer. But it is not of a paramount importance, like in 43 CA, that transfer must precede the payment, transfer must precede the credit. Transfer may ensue, it may follow also. There may not be an agreement also because it does not otherwise refer to such. So therefore, what is 194 IA is concerned, what is important is there is an intended transfer and in respect of which the payment is being made. So therefore, not much would be turning out by insisting that where is the agreement, where is the registration, where is the transfer as is understood otherwise, may not turn out. These are three broad views as far as the year of application is concerned. The next, before we take up the final thing, that is transfer and proceed to the answering of remaining questions on 43 series, that good number of questions, agreement, good number of transactions have taken place before 1st April 2013. Either the premises are booked, either the premises are under construction. In some cases, allotment letters are issued. In some cases, agreements are executed. In some cases, agreements are registered also. In some cases, possession also is parted with. Now, in all such cases, the all-important issue which one has to decide is that would the provisions of 43 CA apply to those transactions? In respect of some of the transactions, the builder-developer has recognized the income. Some have recognized the income in full, some have recognized the income in part up to 31st March 2013. So two important questions which arises. Is section 43 CA retrospective in its operation? Will it apply to assessments of income of assessment year up to 2013-14? That is, whether it has a retrospective effect or not. And the second is, if it is not, which all of us agree that it is not made specifically retrospective. So if it is not specifically made retrospective, the correct conclusion would be that 43 CA would not have any application in respect of assessment of income up to assessment year 2013-14. I have no doubts about it. It's not retrospective in its application. But the question immediately comes back to back is that is it retroactive in its application? Is it retroactive in its application? In respect of transactions which have taken place for which and which are not concluded finally by registration of deed or such other things, which are taking place in this year, then in such cases will it have some teeth to bite or it will have no teeth to bite? This is the question which we need to address. There could be different possibilities and let's examine each of it. But before that, let's examine what is the general understanding of the courts as regards the retroactivity is concerned. We have two direct conflicting views, both Supreme Court views, wherein the Supreme Court in the famous case of Reliance Jute Industries, 120 ITR 921, stated that the law that is to be applied is the one which is prevailing in the year of application. So if you have to apply 43 CA in AY 1450, even though it will expose the transactions which have begun in the earlier years, then in that case it will have an application. And this is a classic case of a retroactive application. As against that, you have a later decision, Shah Sadiq Ali's case, 166 ITR, page 103, wherein a view has been taken that a retroactive application, while it is true, Reliance also was examined in that case, while it is true that yes, that the law to be applied would be the one which is prevailing in the assessment year, But if by applying such law, if it results in withdrawal of a benefit or a promise that has been assured to an assessee, then such an interpretation was avoidable, and the law in such case, the law that would apply even in 2014-15 would be the one which was prevailing in an earlier year. In an earlier year, there was no Section 43CA. So assessment of those transactions which have begun up to 2013-14 and which are to be concluded in 2014-15 or thereafter, income pertaining to those transactions should not be exposed to the retroactivity. Is that possible? The question is Shahzadi or the recent decisions in the case of Gitanjali exports or all those decisions, which have been delivered in the context of 80 IB 10, wherein the retroactivity has been avoided by the tribunal and also by one decision of the Gujarat High Court. Whether those will come to our rescue for application of 43C apparently appears to be very, very doubtful. If not doubtful, debatable. For the reason that this is not a benefit which has been conferred to you that you will be assessed on an income of an X amount and not on an X plus 2 amount. So therefore this is a case wherein but the event has been completed in this year. This could be equated with a case wherein for transfer of an asset which is exposed to capital gains taxation. Take a case of transfer of a capital asset in respect of which an agreement is executed some 10 years back. You have always taken a stand that that agreement is not a transfer, the possession continues with me, and therefore there is no transfer. Now it is in this year that you execute the deed of sale and you part with possession. Obviously you are offering the income in this year. Now in such cases, whether you will have a benefit of the old stamp duty value or not is a different issue. That we will examine independently. What is important is for the cut-off date for applying 43CA, can one take a stand that in respect of all such transactions which have taken place, which have begun, which are the origins in the past years, in respect of that 43CA cannot apply. To my mind, in my personal view, not possible. Not possible. So let us therefore in such circumstances examine that which are the cases at least wherein some window is available, some opportunity is available to get out of the rigors of 43CA. Now let's first see therefore that section 43CA not applicable for assessment of income up to AY 13-14, that is, it has no retrospective application which we have examined. Now other possibility could be where income or part is offered up to AY 13-14, either in full or in part, on your own. But registration is in AY 14-15. In such cases, could you say that as the taxable event has already happened, I have been exposed to taxation of income for AY 13-14 or earlier years, and therefore in such circumstances 43CA should not apply in my case. I would believe there is a possibility. When full income is offered, it will bring into tax the same income again, maybe offered on a different amount, but it will be bringing to tax the same income again. The question would arise where a part of an income has been offered, because I am following percentage of completion method. I have recognized 60% or 30% or 10% of income. But I have recognized the event. I have recognized the income recognition event. And therefore, in such circumstances, can I say that it will not apply in my case? To counter that, can the assessing officer say that, all right, I am happy with what you are doing, I will permit you to do so. But now that the time has come, registration of transfer, I will tax you on the entire amount difference in this year, together with the other remaining part, if it is so taxable. So debatable, but there is a possibility where full income is recognized, yes, possible. I would take a view that, if you agree to this view, that yes, that there is a possibility. And when full income is recognized, 43CA would not apply even for AY 1450. You might perhaps also veer in favor of not being applicable, 43CA not being applicable even in cases of recognition of a partial income. The third and last situation could be that where agreements are executed or allotment letters are issued in past, but income is recognized in AY 2014-15 on registration of transfer. In such case, as we have already discussed this aspect, in such case it may be difficult to avoid the application of section 43CA. But the beneficial position here would be that subsection 3 and 4 will come to your rescue. If there is an agreement in the past and the registration of which has taken place in the current year, if there is an allotment which is accepted as an agreement for the time being, whether that is possible or not, we will discuss it little later on while dealing with specific questions. That in such case, the benefit of the stamp duty value would be available, but not the value which is specified or not the agreed value. To give you an example, is that there is an allotment or an agreement for transfer of premises for 1 crore of rupees. The stamp duty value in that year happens to be 2 crores of rupees. It is this allotment or this agreement which is registered in AY 14-15, at which point of time the stamp duty value is 4 crores of rupees. So, in such cases, it would be possible for you to adopt 2 crores of rupees as the stamp duty value by the beneficial provision of subsection 3, unless you take a clear view that in respect of all transactions which have taken place, which have origin before 14-15, are not exposed to, which I say that I am personally not fair to you. With that, the last discussion would be in respect of transfer, and an important one is that what is this transfer which is the most essential part of section 43C. First, let's appreciate that whether this transfer at all is essential for application of 43C. Like in 194 IA, just before few minutes, I canvassed a view that yes, that transfer is not that very relevant. What is relevant is payment or consideration. So therefore, here in the context of 43CA, can we not say that yes, transfer is not relevant? And what is important is your method of accounting. The argument appeared to be very attractive, but on a closer reading of the provision, you would see that when a consideration is received or is accruing, so far it is good, accrual, receipt are the concepts which are known to us, accrual relates and could be related to the method of accounting, section 145 also, but it proceeds further. A consideration, where a consideration is received or is accruing as a result of transfer. So therefore, what is very important is, in the beginning only the cards are made open, is that you need to have a transfer. If anything which is accruing not as a result of transfer, 43CA perhaps is not a relevant provision. You might seek your answers elsewhere. So therefore, transfer is quintessential for the application of section 43CA. Having said that, the most important issue is having concluded is creating its own problems. Is that what is this transfer we are talking about? We have understood that transfer is essential, but what is this transfer we are talking about? The immediate answer would be, why not section 2 subsection 47? Immediately the reply would come so quickly, is that it has a limited application to transfer of a capital asset. In fact, 43CA itself provides that I am talking about something which is other than a capital asset. A land or a building not held as a capital asset, then 43CA is applicable. So therefore, it surely is not to subsection 47 transfer. Is there any other place see wherein the transfer is defined? You go to 269 UF subclause F. Transfer is defined widely. It's defined, it covers even a lease and such other thing. But we see 20C has ceased to apply and has no application anymore. And it operates in a very different field other than 43CA. So therefore it again is not something which is very essential. And while talking about transfer, we always in the back of our mind that it has to be a transfer of a land and building. So therefore T269 UA also is not that very attractive. Then the third alternative is I go to the parent act, that is Transfer of Property Act. Transfer of Property Act section 5 says that a transfer takes place in the year of registration, and it will relate back to the year of execution of deed of sale or a conveyance, whatever you would call. So therefore, if one were to take this view, then in that case it would be an extreme case that unless a deed of transfer takes place and it is registered, the transfer cannot be said to have taken place. But 43CA once again operates in a different orbit, that is taxation of business income, which is primarily governed by the provisions of section 145, your method of accounting, and section 4 and 5. So therefore, this also may not be very, very relevant for deciding or concluding. Then MOFA also defines transfer in a different manner for a different objective, that is to create a right of specific performance in favor of a person who is under an agreement that has been registered under section 4 of MOFA. So that also may not be too helpful. The next thing is, can I go to the institute and ask them that, what is a transfer? Now, what is Institute's view? Let's see in brief. What is Institute's view on transfers? In the famous guidance note, which came in because the exposure draft which was issued there before did not see the light of the day, the famous guidance note of 2006 provided two important things. It stated, because in the exposure draft and the reply to the query by the expert opinion committee, it was clearly stated that transfer for the purposes of recognizing the revenue even under AS 9 would take place only on execution of sale deed or parting of the possession. And therefore everybody was happy with that. But the guidance note changed the entire tone of this institute's stand on transfer. It stated two important things. That for paragraphs 10 to 12 of Accounting Standard 9, it is necessary that risks and rewards of ownership are transferred. And risks or rewards of the ownership are usually transferred on parting with the possession and endowing the buyer with the position of an owner. Thereafter, he is permitted to deal with the property in a manner which he would like. In short, putting the buyer in control and management of the property. It moves away from the enterprise and vests in the buyer. This is what it is. But guidance note stated that this particular aspect in the context of the builder's agreements, the usual of the flat sale kind, in such cases, this view requires a little further tweaking. And what Institute therefore in the guidance note stated that for recognizing the revenue, what you need to see that is whether the work is done, even a partial work is done, is good enough. The second thing, which is also a cumulative requirement, is you need to see whether there is an agreement to transfer. If an agreement to transfer is executed on registration thereof, there will be a deemed transfer of risks and rewards of the ownership. So in the Institute's mind, once an agreement is executed and is registered, in the Institute's opinion, it becomes a case of a transfer. So coming back to 43CA is that could I therefore recognize this as a transfer for the purposes of 43CA? Apparently, like Supreme Court famously stated that a taxman need not necessarily walk in the footsteps of an accountant. Similarly, you could say that what has been provided by the ICI need not necessarily be valid for the purposes of 43CA. However, when one comes to the provisions of Section 145, one realizes that that 145 does not provide you with any guidance or guidelines in respect of taxation of a builder developer. And for that matter, for no other persons also, not even for manufacturer or a service provider. So what is otherwise agreed upon is that when there is no specific guidance provided by the law, in such cases what has been provided by the accountant should be considered to be binding for the purposes of determining the time or the point of time at which the income is said to have accrued. On this, there is not much of a debate possible. It's a settled position that it is the accountancy that would determine the taxation or would determine the point of accrual in cases wherein the law otherwise is silent. So can I not therefore Section 145 read with the Institute Guidance Note say that in the year of registration of an agreement, a transfer takes place? If this view is acceptable, it will also coincide with our earlier finding about that what is the year of application of Section 43CA. I am aware that there is yet a difficulty about the transfer of land and building. Two essential conditions, one would be transfer and the other one would be land and building. So if for the time being, if one appreciates that this transfer is the transfer that is referred to in Section 43CA is not the one of a kind which is referred to in Section 5 of TOPA, Transfer Property Act, but perhaps is the one which is referred to as a transfer by the ICI Guidance Note, read with the Revised Guidance Note of 2012, which happens on registration of an agreement. That is the time when you have to apply the other parameter, whether some work is done or not. And if some work is done, that is the time the event is triggered, the taxability begins with that. It may not be an end of solution, but it is a beginning of a solution. So this is something which may keep in mind. These are broad views as far as transfer is concerned. As far as 56.2 is concerned, I say that yes, the transfer is not something which is of a paramount importance. What is important is a receipt, which receipt may be in pursuance of a transfer, may be independent. What is important, receipt should be such which is not just physical receipt like that of a custodian or a watchman. It should be receipt whereunder you are thereafter entitled to deal with, manage and control the property as an owner. This is the receipt which we are talking about in the context of 56.7. And 194IA, as we have seen that transfer is not that very important. It is relevant and the payment should be in pursuance of an agreement to transfer. But it need not necessarily precede the transfer. This is the discussion as far as the transfer is concerned. Keeping this entire discussion of about 15 to 20 minutes in mind, if we now venture to deal with the issues which arise, perhaps life would be a little easier. The first question which we would examine is, this is an issue of, now we are on specifics and we will deal with specifics. The issue which we are addressing here is that there is an assignment of a development rights. Here is a case of a developer who had acquired development rights to develop a land. He was not the owner of a land, but he had acquired the developer land. These were valid enforceable rights, and very valuable rights. These rights before development were assigned to yet another person. The question which we are examining that in this case, will developer be exposed to provisions of Section 43CA? Yes. Now, in this case, there are two ways of looking at it. One is that is 43CA at all applicable in this case? 43CA operates in the business arena for computation of a business income. Now, a developer who is not in the business of acquiring and transferring and assigning the development rights, could it be said that he is a person who was holding development rights as stock in trade? If the answer is yes, he was holding it as a stock in trade, 43C is welcome to apply. But if he was holding it otherwise, not as a stock in trade, can one say that 43CA has no deed to buy, has no application? There is a possibility. He is not in the business of dealing in development rights. In his case, perhaps it is a case of holding the rights as a capital asset. Like you hold a motor car, you hold plant and machinery. All of those are the cases, though depreciable, though cases of business assets, but are surely not stock in trade. You are not dealer in that. So therefore, on transfer of it, provisions of section 45 or section 50 and such other provisions are applicable. So if one takes a view that it is not applicable, 43CA, then perhaps there is a relief. Why this attempt is being made is that we have two decisions which have already held that provisions of 50CA are applicable. 50C are applicable in case of transfer under a development right agreement. And if these two decisions are believed to be correct decisions, then why not it apply to 43CA also? Unless I show that I am not a dealer in development right. I am not a dealer in development right. This is one possibility, one exit window which is possible. Assuming that you are not impressed or influenced by what stand I am canvassing. The other possibility is that that if these decisions are applicable, then 43CA also would apply. And a huge and a colossal amount would be exposed to taxation. The reason is here the amount is substantial, irrespective of the quantum of amount is that then in this case, what is the other thing which I can argue about it? Is when there is also a good possibility. Am I transferring land and building? These two decisions say that yes, 50C is applicable. So they have presumed that I am transferring land and building. But can I not say that that I have never been the owner of this land? A developer is not the owner of land. He just has the development rights in respect of development, in respect of the land. These are precious rights, as we have pointed out. But it is not transfer of land and building. So even though there is a transfer, there may not be a land and building. Can I support such kind of an argument? Please go to Tejinder Singh's decision, Kolkata Tribunal, delivered in the context of tenancy rights. But it makes a very pertinent observation in some place. Wherein it is saying that tenancy rights are an interest in respect of the building, but it also is important that before a land can be transferred by an assessee, he should be an owner of the land or building. So here is a case wherein I am not an owner of a land or building. Now I am aware that I would not conclude anything with reference to some findings in some decision, or certainly not tribunal decisions. But these are issues which are extraneous issues, and therefore require some support in the form of some judicial findings. So I am trying to draw one from that. So this is a case wherein if I suggest that yes, I am not an owner of the land or building, I could not be said to have transferred land or building. See, in the context of two decisions, what is heartening to note, and that is how I distinguish these two decisions are. Chiranjeev Rao Khanna was a chartered accountant who with his wife were the co-owners of the land and the building. So therefore, there was not much of a hesitation as regards the ownership of land or building. So perhaps was the case in the case of Arif Hussain, where the development right was parted with by the landlord in favor of a developer. And it was the landlord, that is Mr. Hussain, who was exposed to taxation by attracting provisions of section 50C. So therefore, these cases to my mind are distinguishable as long as the developer is in a position to prove that I could not have transferred a better title than what I was vested with. I was never the owner of it. I could not have ever in my dreams also have transferred land for the purposes of 43C. So two windows, if you agree to this, there is a possibility of getting out of 43C. The next question is, if yes, we have stated that yes, no, this would not be applicable. However, if it is applicable, then can you defer it to the year in which the conveyance takes place? Again, the conveyance in this case can never take place, can never be given or ensured by the developer. It could only be by the landlord who had given him the right, who had given him the development right. And therefore, deferring of it, to my mind, is not something which is an attractive proposition. Deferring of it, year of taxation, and once again going back and back to the year of registration of agreement, if that has taken place, there is no possibility of deferring. Can the benefit of subsections 3 and 4 of this be claimed in respect to us? Wait, I will come back. Need to slow in this. No. Sorry for this. Can the benefit of subsection 3 and 3 be claimed? If yes, whether respect to the date of booking or otherwise? Now we are outside development agreement and we are getting into once again something serious and deeper. This is a case wherein see the developer builder have over a period of years have booked the premises, have issued letter of allotment, have executed agreement, have registered. And at all points of times, the stamp duty values are different. At all points of time, the stamp duty values are different. And now he is registering this agreement in AY 2014-15. So one is that yes, that if we have said that there is a retroactive application in respect of these transactions though have originated in the previous years, are concluded in the current year, and therefore we have agreed that 43CA will have an application. If it has an application, can I seek the benefit of the stamp duty value of the earlier years, by relying on subsection 3 and 4? Apparently, why not? You are activating a new provision in respect of transactions which have origins in the past. Because it is concluded in this, then apply the provisions of 43CA in full throttle, with full force. And subsection 3 being a part of 43CA, I should be allowed to adopt the stamp duty value of the earlier years. If you agree to this, the catch which will have to be addressed is that there must be a complete unison and reconciliation between the stamp duty value prevailing in that year of allotment or agreement or booking and the value at which you have agreed to transfer. If there is a difference and the difference is against the assessee, then in that case I am afraid that difference will be exposed to taxation on account of the retroactive application of 43CA. But still there is a sizable solace in the form of availability of the benefit or shelter of subsection 3. The related part which also we will have to crack here is that what is this agreement which we are talking about? 43CA talks of agreement. 46CA 3 talks of agreement. It says that a value fixed by an agreement, a value fixed under an agreement, something like that. If it is different than the value prevailing on registration of transfer, I am deliberately using the words which are used in the provision only. That if there is a difference, then you are allowed to relate back or adopt the stamp duty value prevailing in the year of agreement. So the reference is to agreement. And what is an agreement? Agreement is the one which is commonly understood by all of us to be an agreement which is printed on a stamp paper and which is on payment of the due duty and which is later on executed and thereafter it's witnessed and thereafter it is registered. Or a booking letter or an allotment letter also or an unregistered agreement also is an agreement. Let's take the simpler thing and through process of elimination move. We'll take the last thing first. That is an agreement which is unregistered. An agreement, and let's also test that an agreement which is not even stamped. Which is not even stamped. Does it cease to be an agreement for the purposes of subsection 3? The apparent answer would be, why should it cease to be an agreement? An agreement is in writing and is executed. What perhaps is influencing everybody is an agreement should be one which is some kind of an official document. And we are not much influenced or enamored, or we are not so demanding that it should be enforceable in law. And that enforceability of specific performance may happen only on stamping and registration within the prescribed time of 4 months. All these things not usually happen in real practice, in real life of the builders. So we come back to this is an agreement which is signed but which is not registered is an agreement for subsection 3. If it was always in place, then in such case, and mind you, when I share my views, I never recommend anything. And certainly I never recommend any doctoring of anything. I'm simply testing the law as is available. If there is an agreement in place, then in such case, it would come to the rescue and the window of opportunity is open to you for the purposes of relating back the stamp duty value. Wonderful opportunity. An agreement which is stamped but not registered, we have said that there is a good news. An agreement which is not stamped and not registered. We have done away with the requirement of registration. Can we not also do away with the requirement of stamping the agreement also? Now it may be so that in your wisdom, and as we will take up other issues in a later case studies, we will see that that sometimes the government's assumption of liability to stamp duty may really be not valid also. Payment of stamp duty of 100 rupees or 10 rupees may also be considered to be due payment. In such circumstances, therefore, for the purposes of 43CA3, I would take a view that stamping of the agreement also is not an essential ingredient for taking the benefit of this. Now go to the third position, allotment. Is allotment an agreement? Those of us who demand that an agreement should be an officious document, allotment perhaps is not. Allotment perhaps is not. But go to any government officer who is practicing this stamp law, I will tell you that if there is a letter of allotment which is being issued widely by the developers, I am inclined to duty this allotment letter itself under Article 5 or under Article 25 of the Bombay Stamp Act. It's another story that that these allotment letters are not exposed to the authorities and therefore they do not attract the provisions of Bombay Stamp Act. So therefore, if an allotment letter wonderfully well when it is a bilateral, when it is accepted also by the buyer by way of signature on a footnote, in my opinion will have a character of an agreement. If it defines the area, it defines the flat, then in such case you would be entitled to go back to the year of allotment. Even though that it has followed with an agreement, you may still go back to the year of allotment and claim that it is the stamp duty value prevailing in the year of allotment that should come to my benefit, and I should have an entitlement to substitute that value as the value for section 43C. The last is the year of booking, which is not back to back followed by the allotment later. If there is a year of booking, there is a payment. Can one turn around and take an extreme stand here that an agreement need not be in writing also? An agreement need not be in writing also. And a booking, what better way to demonstrate that there was an agreement, that the booking amount was paid by check. It was credited in the books of the developer builder. Can one therefore say that in that year I had agreed to, I was under an agreement, the execution of which later on happened by putting it into the ink and was later on registered. And it is because of registration you are applying 43CA and carry it to the logical conclusion right up to the date of booking. I would say not impossible. I would also not say it is very certain that this view could be possible, but I would not rule it out altogether. That booking also is a case of an oral agreement. If with the peripheral documents with some other related instances of sale which have taken place around that date, why would one not be in a position to demonstrate that it was at this value which I had agreed? And you may take a stamp duty value, but of that year and not something else. There is a possibility. So, method of accounting. Can the application be deferred or denied on the ground that the assessee is following percentage of completion method? We had a detailed discussion while dealing with the year of application and also the transfer. So, at that point of a time, I have presented my view that it would be section 145 read with the Institute's revised guidance note of 2012, read with the guidance note of 2006, which should determine the year of transfer. And therefore, in such cases, if you have started recognizing revenue on percentage of completion method, then it would be fair to stagger the application of 43CA over the period of years. There is nothing in 43CA which says that I would apply only in 1 year. What is important is that section 43CA would apply. It would apply with reference to stamp duty value, but if you appreciate that method of accounting will have the clinching view in respect of taxation under section 43CA, then in such case, I would believe that if I am following percentage of completion method, this also would be spread over. I would not concur with a view which says that in the year of completion of the project, the entire difference will be taxed and exposed under section 43. If we have agreed so far, let's remain in agreement about the year of application being, the first year of application being the registration of transfer. First year of application being the registration of transfer. And thereafter, if the method of accounting which you are following will decide the finality of 43C. If you are following percentage of completion, it will be staggered over number of years. If you are project completion method, following project completion method, and if you are so advised, because I am personally of a view that in respect of all projects which are commenced on or after 1/4/2003, project completion method is her history. It is consigned to her history and therefore it's not possible. Howsoever, there are a couple of decisions, one of Jodhpur Tribunal, one of Mumbai Tribunal, without appreciating what is happening, that yes, wherein a view has been taken that what prevents you under income tax law to follow the project completion method. So that if you are so advised, if it is so found to be possible, because today my battlefront is differently defined. It is not whether I can follow project completion method or not. Here the battle line is drawn on the year of application and how to apply the provisions of section 43C. cutoff date, can one contend that section 43CA is inapplicable? This is about cutoff date. Also, we have in detail discussed. What is very heartening to note is that 50C, independent, without the benefit of provisions of subsection 3, 50C had been tested by several tribunals and one High Court also, as regards its retroactive application. In cases wherein the transfer had taken place in the year in which 50C had applied, but the agreements were executed in the years in which 50C was not applicable, that is pre-2003 period. In that case, the tribunal have more or less consistently taken a view. Visakhapatnam, also Calcutta Tribunal, which was the first one to take a view, and Hyderabad Tribunal. They have taken a view that yes, in all such cases, the benefit of the old value will be available for the purposes of computing the capital gains. Benefit of old value. And in that case, the tribunals have not advised or canvassed that it will be the stamp duty value which should be adopted. Mind you, there is no provision like subsection 3 in 50C even today. Even today, ideally it would have been fit for legislature to have carried out parallel amendment in 50C also for relating back the value, which is not so today also. However, forgetting about it is that we have these three decisions of tribunal which have taken a view that you can relate back the value. But there is a disturbing decision of the Calcutta High Court which has taken a diametrically different view. And that is the only decision of a High Court in my view in the case of Bagri impacts. This has said two very funny things. And this was in the context of capital gains taxation. All of us for donkey's years are clear that capital gains tax liability is attracted in the year of transfer. There has to be a transfer, and if there is a transfer, this is the year in which neither year nor that. It's not like method of accounting. It's not like percentage of completion method wherein several different possibilities are open to you. This is a case wherein transfer is of paramount importance for 50C. The High Court famously stated that in case of 50C, after application or introduction of 50C, transfer is not relevant for section 50C. What is relevant is payment of stamp duty and registration of stamp duty, assessment of stamp duty. And if that is the view, then it would be only in the year of payment of stamp duty and registration the transfer would be said to have taken place. I don't agree with the decision. Perhaps it has not been explained to the High Court that this will get into a different orbit. But coming back to subsection 3 is that the benefit of subsection 3, independent of the existence of subsection 3, is read into the provisions of 50C by the judiciary and should also and would have also been read into without its existence in 43CA. This is a short point which I am trying to make. The next question is it consideration or a turnover? Is allotment of flats under a supplementary agreement? If allotment of a flat under a supplementary agreement is subjected to section 43C. Now here it is a case wherein under a supplementary agreement, the builder agrees to grant 50 flats to the landlord. The question which we are examining here is that will the builder be exposed to 43CA? Two ways. Is it my turnover or is it a payment of consideration? Is it my expenditure or it is an item of a revenue? If it is a revenue item, if it is an income item, 43CA is applicable. If it is an expenditure, then in that case, why 43CA should apply? But while I say this, am I not looking into 43CA very differently? In the entire 43CA, nowhere it is stated that where allotment or transfer represents an expenditure, 43CA is no application. This is a case wherein instead of payment of a consideration in cash, the developer has agreed to pay it in kind. Is it therefore not important that a transfer has taken place and 43CA should apply to this? Can I say that it is a payment of consideration and don't bring it into my computation? It's not my turnover and therefore it should not apply. Not a very easy exit available in respect of this. This is a case wherein the builder himself agrees under an agreement which is validly registered for allotment of land which would represent the transfer. Which would represent the transfer. And what is the consideration for him? The consideration for him could surely be stated to be in the form of kind. What has he received? He has received the land. He has received the development rights for which he is making the payment. So therefore, in such circumstances, there is a case of an exchange in this case, and there could be a possibility of application of section 43CA. I will not rule it out altogether. But the two defenses which are possible, I have already supplied. One is that it is an item of expenditure, the other one is it is a case of payment of consideration and not a case of an entitlement to receive consideration which should have a reflection in income and not an expenditure. And the next is sale of TDR. This is case study 2 and with that we will expedite the journey. Is sale of TDR which the builder developer has made exposed to section 43CA? Is it a case of a transfer? The answer is yes. But is it a transfer of land and building? The answer is no. The TDR is an entitlement to upload a bigger construction on the existing construction or on the existing land by increasing FSI. So therefore, when it is not a transfer of a land, provisions of section 43CA in case of a builder developer also would not be effective. This is one, if we can crack, perhaps, we would take home something which is important. That can I claim the unrealized amount as a bad debt under section 36(2)(7), 36(1)(7)? Can I claim it as a business loss? This is the question which is being put up for consideration. Apparently, you would feel that this is a laughing matter, that why should it be discussed at all? Where is the question of claiming this as a deduction? Now, when you are put in absolutely obnoxious situations, sometimes you look for extraneous remedies, which on first blush may not be very appealing, but on a deeper application, might appear to be not impossible. Now take a case, let me give you two examples. There is a case of a person, a builder developer, who has agreed to sell a particular residential premises. And these are ready flats, no other issues are surrounding this, they are not haunting this. So let's take simple cases. And who had agreed to sell the premises for a value of 2 crores of rupees. When he goes for registration, he realizes that stamp duty value is more than the agreement value. In between, either the stamp duty reckoner has been changed or the value had always been more. And the ground reality is requiring to sell it for 2 crores of rupees. The value is 2.5 crores of rupees. Now, in this very same situation, his consultant has advised him two different options. One is to go for an agreement of 2.50 crores, which his buyer also agrees readily, his tax consultant also agrees readily, because he also will be saved of 56 to 70 issues. The other one is that to go ahead and pay stamp duty on 2.50 crores with an agreement value of 2 crores. And in both cases, he has been advised that try the bad debt claim. In the first case, where he has agreed into an agreement for 2.50 crores, it would be correct for him to recognize the revenue of 2.50 crore in his books of account. It would be correct for him to say that in his books of account that 50 lakhs is receivable at the end of the year. And it may not be incorrect for him to claim it in a later year by stating that look here, it is accounted for in my books of account and now I am writing it off. And complying with all conditions of section 36(2). And therefore, in that view of the matter, I should be allowed the deduction of bad debt on account of it. In the first case, the assessing officer tells me, all right, you might be a smart Johnny, but where is the write-off in the books of account? And there is a difficulty. So therefore, the tax consultant comes back with another innovative argument that why not claim it as a business loss? Allow it to me under section 37 or business loss, there is no such a requirement for claiming this. It has been considered as my income, which income is not receivable. So here is a case, all of us have agreed, the groups have very clearly agreed, but for Jan who has been the mentor, that 43CA is a computation provision. His view is that it could be a charging provision, not ruling it out. Apparently, it is finding a place in the computation part for chapter 4D, and it does not create a charge or the year of taxation. It's simply like 50C. 50C is admitted to be a computation provision, and let's keep it that way even for the purposes of 43C. If it is so, all other deductions which are available in computing an income would also be available to me. And therefore, there is a possibility of claiming this either as a bad debt or a business expenditure or a business loss. This is again, as I say, that if I am put in a fix, I'll rather struggle to get out of the fix, and this is an attempt. This is an example of a struggle for getting out of the fix. In 50C also, if I have losses, other losses I am entitled to claim. If I have other expenditure and if they are otherwise 48 covered expenditure, I am entitled to claim. So therefore, we may keep this in mind. We have now 8 case studies and 45 minutes. We'll try to do justice, to the best of our possibilities. There would be several issues, some of them might be repetitive also, and then we will try to cover that at the relevant point of time. Case study 3 is actually an attempt to appreciate the provisions of 50D. 50D is a new provision and therefore is attempt to understand this. The short point here is that in such cases, in cases where the consideration which is accruing or is received is not determinable or is not ascertainable, then in such cases 50D would apply. In the facts of the case which one has given, can the provisions apply or not? I simply share with you the group's views are. Groups are divided. One view is, which I concur with, is this is a case in which the consideration is not ascertainable immediately on transfer. But transfer has taken place, but consideration is related to the future events and therefore is not determinable. If ascertainable, it still is not determinable, not computable. The other view is that in this case there is a possibility of determining the consideration. My question therefore was that if it is determinable, you don't need 50D, even otherwise under section 45, a charge is activated. And to that the group agree that yes, that even outside 50D there would be a possibility of taxation if it is otherwise taxable, if it is the year of transfer. So in both cases, what is important is the application of fair market value. Now, how to ascertain the fair market value perhaps is the short question. There is a product which I have put up in the market for sale, where under one terms of sale, I am required to be paid based on certain milestones which are staggered over a number of years. I am also putting an alternative offer where I am saying that this is the market value. I want this much money. I want 100 crores, or in the alternative, stagger it over a period of 5 years. Stagger it over a period of 5 years, or not 100 crores. I want 60 crores, or maybe 100 crores, or in the region of that over a period of 5 years. Now, in this case, the fair market value therefore otherwise of the product is 60 crores. So, if I were to apply 50D, then it is that amount which is scientifically ascertained that if other buyer would pay me in the ideal circumstances, that would represent the fair market value. This is what I just wanted to test you. The inapplicability part was on the basis of that 50D was apparently introduced on account of very important authority for advanced holdings decision, Dana Corporation, Goodyear, and the other decision. Ankit Amani decision. So in all three decisions, which were basically the cases of reorganization or restructuring of the business, wherein the authority had held that consideration is not determinable, and therefore in that view of the matter, it is not taxable at all, because it is the other name of section 48. 50D, as I said, this is one part of it, which we have discussed. The related part is that can it be taxed in stages? To my mind, it cannot be taxed in stages, because it is the year of transfer which will determine the taxability. There is no provision which would say that a part of a consideration can be taxed in a later year or an earlier year. Then one content that what I have transferred is land liability, and therefore it would not. The group had appropriately identified that what was being transferred, even though if it is a land, it was a land. It was a lease of a land, it was a lease of a factory building, and therefore provisions of 50C also otherwise inapplicable in respect of this case. Then, can one claim that provisions of section 50B should apply and they should override the provisions of 50C and 50D also? Again, the group pointed out that this perhaps is not a case of a transfer of an undertaking. For 50D, what was required was transfer of an undertaking, and in that view of the matter, even that 50D also may not apply. With that, we move to case study 4. The question is, this is in the context of income from other sources, 56.2, and the first question was that if there was a difference in stamp duty value in respect of acquisition of 9 residential premises, will the difference of 22 lakhs be exposed to taxation, and if yes, how? The apparent answer is this entire 22.50 lakhs being the difference will be exposed to taxation, and it will be taxed as income from other sources, the person being an individual. Is payment by seller of stamp duty relevant for attracting provision? Now this is important. In this my premises case, the seller agrees to pay the stamp duty. Under section 30 of the Bombay Stamp Act, the liability to pay stamp duty, unless otherwise provided, is affixed on a buyer of the premises. Here is the case, there is a transfer of incidence of stamp duty. So could therefore, the value which he has paid, the buyer has paid, could this difference of 22 lakhs or 22.50 lakhs be increased by the quantum of stamp duty that is paid? If one would carefully see the provisions of section 56 to 7(1)(b), one would see that what is important is that the charge is packed with reference to the difference between the stamp duty value. The difference between the stamp duty value and the agreement value, so D value. So therefore, if the stamp duty annual value is a fixed thing, then in such case, one of the parameters is unshakable. An agreement value being the other, which also is not turnable. In such case, I am afraid that 56 to 7b would not have apparent application. However, could you increase the quantum of the amount that is exposed? Once again, go back to 56 to 7, subclause B is that it once again requires you to only ascertain the difference between the values. The values have been provided, which values have been provided for, and therefore you cannot substitute that value by increasing it or decreasing it. By increasing it or decreasing such value. Will seller also be taxed on the difference under section 50C? This is the reason that why one seeks to say, one wants to suggest that this is an obnoxious provision. This is a case of a clear double taxation, where the seller who is a developer builder will be exposed to taxation under 43CA, though there may not be any cash exchanging hands. It will be the seller who will also be exposed to tax, and it will be the buyer who will be exposed to tax under 56(2). So either 43CA or 50C on one side for seller and 56(2) for the buyer. And that is why there is a difficulty here. Is there any remedy? Why not? There always is a remedy. And for that, look into the proviso. That yes, provisions of 50C are imported into 56 to 7. And therefore, you are welcome to make an application to the assessing officer under 50C2 and seek a reference to the development officer. The only advice is make a written application to the assessing officer for a reference, and thereafter file your roadmap. Okay. Is there any consequential relief available? Yeah. Is there any consequential relief available? And look into the beautiful provision of section 49(4), which at least saves the buyer, from the difficulty which he is facing. Though he may be asked to pay tax, make no doubt about it, but his cost of acquisition of that premises is accelerated on account of section 49(4). And as and when he eventually would sell those premises, he will be able to deduct the cost of acquisition. He may be saving on taxes at a concessional rate of tax. There may still be a leakage of revenue. There still is a relief which is available in the form of 49(4). Now we move to new Delhi premises. Can an under construction premises treated as land of building and therefore be treated as liable to income from other sources? And here the answer could be very materially different. This is where we are trying to appreciate that all provisions are different. Now please look into it. 56 to 7, by way of explanation, says that an immovable property is the one which is land and building. It's circuitously defined, but it still is restricted to land. Scope is restricted to land and building. So therefore, something which is yet not ready could not have been received. And as we have agreed that for 56 to 7, what is of importance is receipt. If I have not received the flat, 56 to 7 may not have any application to my case. So there is an agreement. That agreement is executed, it is stamped, it is registered. But I have not received the land or building. And in the absence of a receipt, simplicity, a concrete, valid, physical receipt, which may happen outside the agreement also. What is important is receipt. So in such case, in respect of this agreement which we are talking about of new Delhi premises, at that point of time, there would not be taxation. This is not the point of taxation, it is not triggering taxation. It may be subsequently, on receipt of physical possession in pursuance of that agreement, that we will have to examine the implication of 56 to 7b. And at that point of time, the proviso 1 will come to your rescue by allowing you to substitute the stamp duty value for the purposes of income from other sources taxation. This perhaps is the right way of reconciling all issues which would arise in respect of the existence of the identity. This was a short point which was just because of what all is happening all around in the state of Delhi, which is perhaps a city of Delhi, which is because the central government believes that it has power to administer, and the state government of Delhi is nothing but a municipality, and the leaders have behaved like municipal leaders only. So the short point was that is New Delhi a state government, or for the purposes of our discussion, a state government as one has examined it, that the state government of New Delhi does not legislate on the Stamp Act. It adopts the Indian Stamp Act, or perhaps the central government administers and applies the Indian Stamp Act in the context of it. However, whether it is a union territory or whether it is a state government, for the purposes of 56(2), it is irrelevant. This is the point which one is trying to put forward. That when it comes to 43CA, when it comes to 50C, the location of a land and the administration of the act by the state government is very important. But when it comes to 56(2)(7), this distinction is not, because there even administration of law levied by the central government also is specifically exposed by the state and the central government. When it comes to 43CA, it is restricted to, scope is restricted to state government authorities. When it comes to 194IA, it has no application because stamp duty has no relevance. But when it comes to 50C, once again the limitation is that of a state government authority. So keep that in mind, may perhaps be helpful. Is receipt from a brother exempted from application of 56(2)? All groups are unanimous that in such cases, the application of 56(2)(7) would not arise. Brother being a relative, there will not be any liability under 56(2)(7). Will one be allowed to claim losses on sale of flats? This is the flat which I have received from my brother for an inadequate consideration. For an inadequate consideration. It is not a case of a gift I have purchased from my brother, but for an inadequate consideration. We have concluded that inadequacy will not expose me to any taxation under 56(2)(7). However, when it comes to transfer of that, can I substitute the accelerated cost by taking shelter under 49(4)? No, sir. The provisions of section 49(4), the language of it is otherwise also is difficult to comprehend this. What it says is that I should be allowed that as a cost of acquisition, which should be the value which has been subjected to income tax under clause 7. It says that it is the value which has been subjected to income tax under clause 7. Now here, the entire value is never subjected to this. It is the inadequacy only which is subjected to taxation. So on that count of a literal interpretation also, there is a difficulty in adopting the accelerated cost of acquisition. Unless I demonstrate that the entire value is exposed to, subject to taxation, which it is never, unless it is a pure case of a gift. So what should have happened is, this is I am just explaining, or rather highlighting, the deficiency in not carrying out the parallel amendment in 49(4). When you introduce subclause A, you also should have amended 49(4), unless your intention is that in all cases of inadequacies, 49(4) would never come to your rescue. There is yet another third possible interpretation which also is possible, but today we are not discussing that. So this is a case wherein this is one part of it. The second part which we are testing is that brother is not exposed to taxation under subsection 7, if there could ever be any such taxation. So therefore, brother is not exposed, and therefore the groups are of a view that in such case the brother would not get an accelerated cost of acquisition. accelerated cost of acquisition. My other view possibly is that yes, I am exposed to 56 to 7, but by virtue of an explanation, I have also been exiting out of 56 to 7. And therefore, the benefit of 49.4 at the threshold should be available to me. Not an absolutely ruled out or impossible case, and perhaps can try. This is perhaps a possibility. Then we borrow the premises. This is a case where allotment letter is given in 2003 and the agreement is open today. Can I take the benefit of the letter of allotment by stating that the first proviso will get me or permit me to substitute the stamp duty value prevailing in that year? As after the detailed discussion which we had from time to time, I would believe that it is a fit case where the benefit of substituting the value should be available to the system. Retroactive part we have discussed in detail in the beginning. This is yet another one. This is a land at Kochi. In respect of post-dated checks have been issued on the date of agreement itself. The agreement is registered. On registration, the premises are received also. Obviously, you will see whether 56 to 7 or A or B is applicable. And you would carry out the scientific data calculation that find out the stamp duty value, find out the agreement value, both of them are matching 56 to 7 is not affected. Then you come to realize that the buyer who had promised to give you 50 lakhs of rupees has no money, his post-dated checks have bounced. And he is in the immediate near future, he is not going to make any such payment. Two things. So when realizing that, can assessing officer say that look here, he is never going to make you the payment, and therefore I will expose you to 56 to 7. You can get into interesting discussion, but the answer would be that no, it would not be exposed to taxation. Now, what happens is that the seller waives off the recovery, realizing that it is not going to come at all. And to mark the point of waiver, he also writes it back, writes it off, in his books of account. Can at this point of a time 56 to 7 clause C be attracted, which is independent of this, which says that on transfer of a property for no consideration or inadequate consideration, I will apply and I will tax you under income from other sources. Can waiver be considered under clause C? The apparent answer once again is no, for the reason that the property has a limited definition. And therefore, all that is defined in explanation clause F only is the property for the purposes. And waiver of a debt not being the one which is treated as a property, there would not be any exposure to taxation even on a write-off. So, case 35. Now we are back into this 194. We are now entering into 194I. This is a case where the first question seeks to determine that for the purposes of determination of the consideration, which in the context of 194A IA is minimum consideration should be 50 lakhs rupees or more. Should it be examined? Should this threshold or limit be applied for each of the owners? That is, each of the co-purchasers or each of the co-sellers. That is what it is we are trying to do. So first we are trying to take up the case of a purchaser. Here the first issue is whether what is the status of the purchaser that is relevant or not. The status of a purchaser is not relevant. He may be a non-resident, he may be a company. All such things are irrelevant. What is relevant is the status of the seller in this case. Are they applicable to non-resident seller? If no, are they applicable where one of them is a non-resident seller? As we have stated that 194IA applies only to the case of a resident seller. If the person happens to be a non-resident seller, in that case 195 would apply. and not 194 IA would apply. But there would be cases wherein these are the cases of joint ownership. These are not the cases of owners with definite shares. They are not the cases of tenants in common, but they are the cases of joint tenancy. They are the cases of ownership, but they are joint owners. And one of them happens to be a resident, another one happens to be a non-resident. In such cases, how would you crack and reconcile and apply provisions of 194? Answer is provided by different circulars issued by the CBDT from point of time, not necessarily 715 or 718, but circulars wherein such issues were raised, wherein the board has clarified that in case of joint ownership, wherein the specific co-ownership is not there, in such cases the status of the first owner, whose name appears first in the agreement, is the case which will define the applicability, and I am content with such application or such interpretation. Is limit of rupees 50 lakhs prescribed for each co-seller? We have concluded that for each co-purchaser, we will apply the limit. Can we therefore not also apply this for each co-seller in cases where each of them have a definite, specified, defined interest in the premises which are being sold? If it is otherwise logical to conclude that it is for the purchasers, then in this case also it should be for each co-seller. And therefore, if there are two purchasers and two sellers, which are so in our case, the overall limit would be that of 2 crores of rupees and not 50 lakhs of rupees. This limit of rupees prescribed, 50 lakhs prescribed for each purchasers which we have seen. So, the next in line is position of outstanding balance to be determined with reference to each owner. This is a case where the consideration payable after 1/6/2013 is to be less than 50 lakhs, or the overall consideration is to be 50 lakhs or less than that. This is what we are trying to examine. And it is a case that should you examine the limit with reference, should you examine this limit with reference to the balance payment or the absolute consideration. The board in the past has clarified that yes, what you need to do is that in respect of the previous payments, we will not expose you to TDS liability. But for determining whether you are liable to TDS or not, you will have to take the absolute limit and not only the balance consideration that has remained to be payable. This suits me for the reason that this also reconciles with our other view that 194 IA does not necessarily require that transfer must receive the payment or the credits. It has its independent attraction. So prior payment, and this is answer to question 25 of circular number 715. The next question is cut-off date. Is there any obligation to TDS where payment or credit is made? As we have seen that what is important is the event. If I have made the payment before that, the board also considers that I am not tax you in this factor. Now here is the case, if I have credited you before that in entirety, I would also therefore take a view, though there is no direct clarification of the board on this, that if I have credited the account of this seller before that, I would thereafter not be made liable or exposed to any TDS in respect of this. So if you are otherwise in the habit of crediting the seller's account in respect of the entire consideration of purchase, then in that case, like the payment part, you would not be exposed to the taxation. If I have credited in part, the balance credit thereafter would be exposed to taxation. What happens where I have not only credited, I have paid, but I have received the premises also. Then in such cases, simply because the agreement is registered later on, can I be said to be attacking provisions of 194 IA. We have an old circular of 1972, I believe, which wherein a view has been taken that if the work is executed in the context of 194C, then in that case it will not attack the provisions of TDS even though the payment has been made later on. Transfer under an agreement before cut-off date liable to this part we have already seen, but which has a retroactive application, though transfer is taking place later on, or even if it has taken place earlier, if the payments are now being made, credits are being made, it will expose you to taxation. This is something on which we need to develop some understanding. Today in bigger cities, most of the premises are purchased through the help of financial institutions. Finance is provided by institutions which may include bank also. There could be third-party finances also. The issue that requires consideration in these cases is that how to deduct tax at source. Or can there be no liability to deduct at tax at source because the payment is made by the lender directly to the builder. In such cases, cannot take a stand that 194 IA is not applicable. My view would be that it would be futile to do away with the liability of 194 IA. The lender who is making the payment is my agent. He is making the payment at my behest. It is not his payment for purchase of the premises, it is my payment for purchase of the premises. So I as purchaser of the premises, is required to deduct at source. So I need to settle or set out a mechanism to enable me to deduct tax at source. The simplest way is to ask the lender to make a payment after deduction of tax at source on my behalf. And the other simplest thing is thereafter follow it up with the payment to the government, which should be credited in my tax account number and not in that lender's tax account number. I believe the groups concur with this finding, but this was not something because of the time which was available to me. I have not been able to raise this issue. But I believe that groups are in agreement with this. If there is a difference, we can later on tackle this. Exchange, this is yet another thing which we need to appreciate this. Yeah. Are provisions of section 194 IA applicable to a case of an exchange? If yes, to whom it may apply? Now this is a case where you make part of the consideration. You make payment of part of consideration in kind, which is in the form of transferring the land. You are acquiring a premises, on other part you are transferring the agricultural land which you are owning. Assuming that it is not an agricultural land, then in such case, who is the person who is exposed to taxation? And who is the person who is required to comply with provisions of 194 IA? I would believe exchange is a case of a two-way transfer. The payment though made in kind, it is a case wherein the buyer would be required to deduct taxation. For buyer of the land who is receiving consideration in kind would be required to deduct taxation. So he is the transferee. And in respect of the flat, the payer who are the transferees would be required to deduct taxation. So this is a case. This is a two-edged sword, wherein both the parties would be exposed to provisions of 194. When does the transfer can be said to have taken place? As I have already pointed out, that transfer may take place at any point of time. What is important for 194 IA is that there should be an eventual transfer. I have no disagreement with it. What is important is payment must be made in pursuance of an inter-day transfer or actual transfer, whichever is the time that would expose you, either the payment or the credit. Is tax required to be deducted with reference to the stamp duty value? 194IA has no relation whatsoever to the stamp duty value. It is the agreement value on which taxes are required to be deducted at source. With that, we can come to case study 6. This is again the case of 43CA, and this is the case wherein under through several examples, real life situations, we are trying to understand whether 43CA would apply, and if yes, at what point of a time it would apply. The first issue is applicability of 43CA, determination of FEC to a land located in a union territory. As we have already seen that 43CA has no application to a land or a building which is located in a territory wherein the state authorities do not monitor the levy of stamp duty. This is one part. To a lease of land. That whether 43CA would apply to a case of a lease of land. Now, a lease could be a transfer under a Transfer of Property Act, but would otherwise not be. Would otherwise not be a transfer, and that too, it may not be that of a land or a building, transfer of a land or a building, and therefore would not apply, as has been held in Atul Puranik's case. This was a case wherein what the tribunal was testing was a long-term lease of about 60 years. And still it came to a conclusion that it was not transferred for the purposes of section 50C of the Act. And the same view should hold valid and good for the purposes of section 43CA. To a deed of assignment for development rights is something which we have already examined, that deed of assignment of development rights also would be outside the ambit of 43CA. Then to an agreement for sale or transfer of land to be completed by removal of encroachment and grant of possession. Now this is a case wherein the possession is not parted with, so transfer may not be completed. However, if we concur with the view that what is important for 43CA is an agreement for transfer and registration of them. If that is important, then in that case, it may not be important that the finally transfer has taken place by handing over the possession or not. Unless one, because the other view is not impossible, unless one takes a view that under this income, this agreement, no income could be ever said to have accrued, because there is no enforceable right, there is no entitlement to receive any money. If that view is taken, 43CA would not apply and would apply only in the year in which the encroachments are removed, and which appears to be a better view of the matter. To grant of monthly tenancy rights, by and large, by now we are clear that tenancy is a right or an interest in a land or a building, and it is not a land or simpliciter. So even though there may be a transfer, 43CA would not apply. Your income may still be taxable under section 28, but 43CA would not apply. To agreement to sell premises under construction. Now here we have taken a view, a conscious view, reading it with guidance note, that even in respect of premises under construction, to the extent to which the work is completed, there would arise a need to recognize revenue, and to that extent, there would arise a need to recognize partial transfer of building. Nobody says that that the building which you are transferring has to be complete in all respect for application of 43CA. There is nothing in 43CA to read it in this manner, and therefore, earlier when I canvassed my view that it is possible to stagger and spread it over a number of years, because here the transfer of building is taking it in parts. And that transfer is the one which is defined by the institute read with section 145. In nutshell, if you don't like institute so much, then it is defined by a matter of accounting. So it is the matter of accounting which is deciding whether it would be taxed in which year. And of course, the benefit of subsection 3 would always be available to me. To a JV agreement for development of plant, difficult to crack, is that if you take a view that I am not in the business of executing JV, which appears to be a good view, and something which I am, tending to support, is that I am not in the business of executing JVs. And therefore, even if there is an income arising out of JV, 43CA is not applicable. My immediate need is not to get out of taxation, my immediate need is to get out of 43CA. So therefore, we are not today discussing what is JV taxation, what is the point of taxation of JV, which is $1 million debate in the city of Mumbai and city of Pune and other cities. That whether JV at all attacks the taxation and if yes, at what point of time. That is not which one. Here I am saying I am not in the business of executing JV, and therefore it is not a case of development agreement. If I am taxable, tax me under the head capital gains, and therefore this is not. This is one way of looking at this. If you don't like this view, then the other view would be that there has to be a transfer, and that transfer should be that of a land and building. Now, if JV is considered to be a transfer, not necessarily under 2 subsection 47, not necessarily under section 5, but under the method of accounting, which is very, very difficult to, but I am trying to reconcile. Even where it is considered to be transfer, there is a question of transfer of a land or building. I have just exposed my land and I have allowed the developer, the co-venturer, to enter into the land and construct premises thereon. By and large, this is suitable and convenient. Subject to one major difficulty is that I have also permitted him, endowed him, conferred on him the right to transfer the developed premises with the land underneath it. Is this not a right which is a right in land which I have created? And therefore, in that view of the matter, there is a difficulty. So this JV taxation would remain open. My job was to present both sides before you. My personal view is that I am not in the business of executing JV, and therefore any resulting income on account of execution of JV would not be exposed to 43CA. Mind you, that whatever goods which are finally received by me, that is the developed premises, and as and when they are sold, of course, they would be exposed to 43CA. There is make no mistake about it. It is in respect of the rights in land, that is the one which would not be exposed to 43CA. To a deed of conveyance of properties agreed to be transferred before 1/4/2013. As we have seen that here, this is a case wherein if agreement was not executed before that at all, and you have straight away moved with execution of a deed which is registered in the current year, the provisions of 43CA would apply, but benefit of subsection 3 and 4 would surely be available. To a sale of land in Silvassa, a union territory, we have already considered. To a letter of allotment issued, this part also has been considered. Letter could be considered as an agreement. To an agreement for sale, stand for ₹100. This requires 1 or 2 minutes. And at the time when I executed the agreement, the stamp duty that was payable was ₹100 only. Because it is my understanding of Bombay Stamp Act is that unless I provide for possession, the stamp duty that is payable is the one that is payable as on agreement, and that is ₹100 only. So if that is the correct position, 43CA would not be exposed in the year of agreement. Because whatever stamp duty I have paid is the correct payment, and if that is the correct payment, There is no other duty which is levied ad valorem, which is levied on the basis of the value of the property that is transferred. And if that is so, there would not be any liability in the year of execution. Let us carry it further, that when eventually this 100 rupees agreement is converted into an agreement which is exposed to duty on account of the deed of sale, and if I take a stand that a transfer takes place in that year, because I am recognizing revenue in that year, then in that case, the benefit of the value which was the agreement value would be available to me in totality and not the stamp duty value that I will substitute for the purposes of 40%. To an agreement for sale not liable to stamp duty, at the time when I executed, this was not exposed to stamp duty because there was an exemption under section 9 of the Bombay Stamp Act. This all happens in real life, and these are most of the questions which we are discussing are the questions which have been examined in the last 11 months or thereabout. And there could be a good number of questions which have still been open and which have not been put up for our debate. So this is a case wherein the exemption was available at the time of execution, but at the time of registration of it, the benefit of exemption is withdrawn. And the buyer does not mind payment of stamp duty. Now in this case, the question which arises in the hands of the builder developer is that will provisions of 43CA apply to his case? To my mind, one will have to go back to that and take a view that 43CA has no application in such extraneous circumstances wherein stamp duty was not leviable at all. Because otherwise you will end in a situation wherein the benefit of subsection 3 will be totally denied to you. To sale of shares. Now apparently when you sell premises through the medium of share purchase agreement, then in that case you would be in a position to take a stand that what I have sold is not the land or building. I am not in favor of such an argument, is that when it is incidental, you perhaps would be in a position to take. But the only asset which the company has is the premises, then in that case, by effecting the sale of shares, you are transferring in effect a land or a building. And in such circumstances, stamp duty authorities are very clear that they are subjecting it to the stamp duty. If that is so, provisions of 43CA also, in my view, should apply to these cases. This part we have discussed that yes, that 43CA would not override but would reconcile with the provisions of section 145 and each of them will complement each other so as to make some sense out of 43CA. Case study 7, I go. Yeah, or stop. Okay. If it is available, yeah, this is okay. Case study 7. Whether current, most of it is covered, so we will be able to 7 and 8. These are the two you may permit me to deal with. 8 is little different. Yeah. Okay. So when it is tenancy, then in that case there is no transfer. But 194IA also there would be no land and building, and therefore there would not be any liability to TDS. We are back into this. This is a case of a redevelopment, and that is why this is being examined. This is a case wherein a developer has acquired development rights in respect of land. And against this, he has agreed to give permanent alternative accommodation. And he has also agreed to give host of monetary benefits. The overall case which we are trying to examine is that the tenants or the members of the society liable to TDS? We are also trying to examine that is developer at some point of time liable to examine. If I may take the entire case study, in a summarized fashion, the views are like this. That when a developer enters into an agreement for acquiring the development rights over land and building, these are redevelopment rights. there is an acquisition by him. There is an acquisition by him and he is the buyer of premises, that is land or the building or both. So therefore at that point of a time, in his case 194 IA would be applicable. The consideration he is making or paying is in two forms, in kind and in cash. As far as the consideration which is being paid in cash, there is no doubt that it will be exposed to section 194 IA. As far as the consideration which is making in kind, that is by granting the permanent alternative accommodation, once again, in my mind, there is no doubt that it would be exposed to 194 IA. The only difference is that should it be on a market value or should it be the only difference is should it be on the market value or should it be based on the cost of construction. To my mind, for him, the consideration is the cost of construction. It's not market value of the flats. And therefore, builder is required to comply with 194 IA in all such redevelopment cases, qua the monetary consideration and qua the consideration that has been paid in kind. As far as the members or the tenants are concerned, are they selling something for which they are receiving some consideration? We have agreed that they are selling it and they are receiving consideration in cash or in kind. As far as cash consideration which is being received by him, the question of attacking 194 IA does not arise at all. But as far as the consideration which they are receiving it in kind, there is another way of looking at it is that they are also acquiring a building. If they are acquiring a building which is being transferred for a valuable consideration, which in this case now have been met by payment in kind, that is parting with the land or the flats in which they were already residing in. So again, this is a case of a two-way exchange, this is a case of an exchange, a case of a two-way transfer, and in respect of the acquisitions of the flats by them, for which the payment is made in kind by way of surrendering the rights, it is that value that would be exposed to tax TDS under 194 IA. If one were to comprehensively decide this is the summary of my views on case study 7. And then see in tidbits it could be what would be the sum. There is also an issue that when payment is being made in kind, can it be considered as payment of any sum or credit of any sum, and therefore it would be exposed to taxation. If you would see in the past, some of the circulars have examined this independently, whereas they are not enamored by the view that payment should be always by way of a monetary consideration, and a sum would include a monetary consideration, non-monetary consideration also. Two other aspects which were examined here was that reimbursements and service tax and VAT also. Now, service tax fortunately have been resolved by a board circular number 1 of 2014. We have started the year with a good note, wherein the board has considered that if taxes, and here it could be service tax, it could be other taxes like VAT also, if taxes were as per the terms separately payable, then in that case they would not form part of the consideration. It is so in most of the cases, and therefore it will not form part of the consideration. For defining the value of consideration of rupees 50 lakh, which is also important to me, and which otherwise also, even if it is forming part of consideration, it will not be exposed to taxation, TDS, because of circular number 1 of 2004. The other aspect is reimbursements. Can reimbursement be ever considered to be part of consideration? And therefore, if you read subsection 2 of 194IA, you would agree with me that reimbursements also are outside the consideration, value of consideration, and what at the most could be subjected to TDS is the value of consideration and not something beyond that. So this is case study 7 in totality. In between, if supplementary is taking place, which has the effect of transferring today or in future, I would take a view that even those agreements also would expose you to section 194IA TDS. Case study X8 is a very different kind of a thing, wherein we are just trying to test the different cases of deemed transfer, 45.2, 45.3, 45.4, whether in all such circumstances, again I would summarize this, whether in all such circumstances, can one apply 43 CA or not? Again, see, one will have to examine the case. If you are introducing capital asset, there is no such question of application of 43 CA. If you are not in the business of introducing capital assets, again there is no application of 43 CA. But as a business transaction, if you have introduced 43 CA, one will have to be little careful for the reason that in such circumstances can 43 CA apply or not. Apparently, even if you consider that there is a transfer, the point would be transfer to whom? Even if there is a transfer, even if transfer is of a land or building, transfer to whom? And therefore, on third count also, 43 CA would not apply. When it comes to 45.2 would not apply. That is a case of a conversion, and in case of 45.3 introduction case, we otherwise have the two defenses available. In case of 45.4, when the firm has distributed stock in trade, can 43 CA also apply or not? Now, as one would see that 45.4 operates in a different field and 43 CA would operate in a different field, that is in taxation of business income. But this issue had been particularly raised because we have a special bench decision in the case of United Marine, wherein a view has been taken that even when there is a transfer of a depreciable asset to which set provisions of section 50 apply, there would be a case of applying 50C also. So this is something we will have to leave open as far as the cases of deemed transfers are concerned. By and large, my view would be that provisions of section 53CA in such cases would not apply. As far as case studies 9 and 10 are concerned, both are covering the cases of 194IA and they do not deal with 43CA. So one is requested to look into this. If I have not been able to cover that, the inadequacy or the deficiency is on my part. My sincere apologies for that. If there are issues surrounding that and if they have not been sorted out in the group discussion and if one wishes to discuss it at any point of time, you are welcome to do so. With that, I'll thank you all the participants, for having heard me on different issues on which I am very clear that the views which have been expressed are possible views and there could be other views possible. What I am happy about is that the groups have shared their collective wisdom, and it is such platforms which provide us with an opportunity to collectively grow in profession and also in life. I am also thankful to Paras for having extended my time. I am also thankful to the Chamber for having given me an opportunity. Thank you so much. Thank you.
I request Mahendra Bhai to come forward.
In fact, Kiran's group was led by his partner also, who should also be, we should use that also. Yeah.
We are doing that.
Kishore is from Pune, and he had also contributed a lot in formation of my views also.
Thank you, Mahendra. Before I even try to make comment there's some announcements to be made. Immediately after this session, we have a group photograph at the stairs of this building. After that, there is a lunch at the same restaurant where we had the breakfast already. After that, before